Hi there, Tom Suvansri, Premier Trust Advisors. Thanks for joining me on this video. The title of this video is whole life insurance a bad investment? And you may hear that from folks like Dave Ramsey or Susie Orman or even your local investment advisor. Most would say that term insurance is the way to go. It's the cheapest way to buy life insurance and protecting your life. And you go invest the rest in the stock market or something. And when you approach retirement, you can get rid of it. You don't need it in retirement. It serves no purpose. And what I would really encourage you to stay on this video just to see a different perspective on it, because I think we are too often quick to assume that what experts, quote unquote experts, say are accurate. And the truth, we have to do our own digging and take responsibility for our own learning to see both sides of a situation so we can make a better decision for ourselves and our families. And we owe that. And especially around our wealth, there's so many areas like this where the assumptions are never tested and the truth sometimes really doesn't come out. So stick with me here and I'll share you a different perspective, because if you ask me what is whole life insurance a bad investment, I'm going to say that it's neither a good or a bad investment, because it's not even an investment. To me, it plays a very different role in our wealth building in our financial lives. So for starters, whole life insurance can be used for your entire life. And it starts with protecting your number one asset, which is your ability to create and build wealth and create value for others. That as you're younger, you have more human capital that has not been materialized yet. So you're protecting that, right, for your future, especially with families, right? Your ability to earn and create value, you're protecting that with life insurance. And that's really what it is. So that death benefit that's tax-free protects wealth you would have built if you were still on this earth. And that's really key. And so whether it's term insurance or whole life insurance, it's still good to have. But whole life insurance is one where you're actually using pennies to secure dollars that you get to keep for the rest of your life. Unfortunately, for most people, term insurance, they're going to outlive it. And then all the money they put into it and the death benefit, their families never experience any benefit from it. Yeah, they got protection along the way. But in the end, a lot of that wealth is squandered and there's a significant amount of opportunity cost in it. So as you're building wealth, protecting it from death and disability is massively important. And whole life insurance can do that in the early stages. And you can have term insurance with it, but whole life insurance can play that role, and you're building up, which is the second piece, a storage of wealth. To me, what I think about whole life insurance and designed properly, it can actually sway towards to more storage of wealth and building that up faster. That's the biggest complaint about the typical whole life insurance, is that it takes a long time for accumulate wealth and cash value. Well, designed properly, you can actually speed that up very dramatically. And as time wears on, it gets much more efficient. And because the cash in there is compounding without a drag on with taxes. So all that money in there is just compounding over time. And as it matures, it really can be a tremendous storage of wealth, and it mitigates taxes later down with the line in retirement, which we'll talk about. So for me, I found that especially design whole life insurance, can be the best place to store wealth, a savings where you have liquidity, cannot be lost, and has the benefit of being shielded from taxes and creditors in most states. Now, back to the investment side, properly designed whole life insurance that builds up cash much faster can be deployed for investment or financing other needs in life, like college. So this becomes a banking. You may have heard things like infinite banking or privatized banking. This is where you can actually store your wealth while it's compounding, earning, moderate rates of return that's going to exceed inflation and is tax-free, while you can actually deploy that wealth in a secondary purpose, like investments or financing big purchases, because now you can act as the bank. And what's built into these policies is a guaranteed loan provision from the life insurance company. So you're not borrowing your money, you're not using your money, you're using their money to use elsewhere while yours continues to grow undisturbed. And that's part of the magic of it, is just simple compounding interest. Let yours grow, compound, and leverage someone else's resources to even build your wealth even faster. So you can use life insurance money or even the bank money to grow your wealth even further in real estate or stocks and bonds or businesses, whatever you want. It doesn't really matter. It's just a leveraging tool to deploy someone else's wealth to build your own. So you can have your money working in multiple places within the policy and outside in investments. So that's where it can really sort of accentuate what you're doing with your finances while still having the benefit of protecting your assets and your life. Now, as we migrate towards retirement, and most people, if you go down the road of term insurance, that you're going to get rid of it and you don't need it, and you might be right, you don't need it. But if you understand how this will work in retirement, you would likely want it, because life insurance now, as it's maturing further down the road, becomes a very efficient tool for a safe portion of your portfolio, right? It's growing in the 4 or 5% range, tax-free, that could be used as tax-free income in retirement. And secondarily, it can be used to buffer the volatility of the stock market. Obviously, when you're accumulating wealth, volatility is not so much a factor because you have a little bit longer run to sort of deal with those ups and downs. But it really becomes more apparent. The risk becomes bigger with the volatility as you migrate into retirement. Big losses, that's the last time you want to use those dollars. So having a buffer asset that has no sort of impact from stock market volatility is a great tool to have, and it's still very productive. So you can pull that money out to use in the off years when the market's down and let it regrow. So you can use them in combination with each other and manage the volatility more efficiently. And so not only creating income, but allowing your other assets to work even better and more efficiently. And then lastly, what we think about legacy plans, when people say, oh, life insurance only for the wealthy, so they can pass more on for future generations. But as far as I know a lot of people who are looking to build legacies for their families and their children, their grandchildren, or provide for charities that matter to them. And this is a great way to do it, because if there is a whole life policy in place in retirement, now you have a built-in legacy planning tool in the death benefit that's tax-free. You get to use all the cash value and all the other assets you've built in retirement for your own enjoyment, and you've already allocated a portion of your wealth in the death benefit that is much higher than your cash value to use for legacy planning and for charities or whatever it is you want and care about. Now you have a built-in mechanism to do so in a very tax-efficient way. And so this is why there's extreme benefit to having whole life in retirement. And also it also can serve partially as a long-term care sort of equivalent. It's not exactly long-term care, but it has some of those characteristics. You can use the death benefit if you experience issues in retirement that you can't do certain activities. And then there's also other benefits of, if you become chronically ill, you can use those death benefits in retirement to help you live it and the remainder of your life in a higher quality. And so to me, this is why when you look at it in totality, whole life insurance, calling it an investment is just the wrong comparison. It is not an investment. It can be obviously a protector of assets and income. It is a cash management tool because you have the functionality of loans, and it can be a way to pass legacy on and help you utilize your assets more efficiently in retirement. So it plays a lot of different roles. And so what I would argue is that I don't think about it as an investment, thinking it more broadly in how it helps you protect, grow, control your wealth, and build your wealth even farther, and then preserve it, really gives it a different flavor and different view, and is an important asset to include in your portfolio outside of just investments. So I hope this gives you a lens into it. I know I went pretty quickly through it, but sometimes it does require just to step back and say, what are these things? Why are wealthy people using these tools? Why can't everyone use them? And it's because we're sometimes taught a simplistic way of looking at things, and oftentimes we don't get an opportunity to see the full picture. So I hope this was helpful, gives you something to think about. And certainly if you want to learn more about them, certainly reach out. Love to have a conversation and see if there's any fit for you and your family and your goals.